Most people see Nvidia as a $3 trillion stock ticker. They are wrong.
Nvidia is not just a company anymore. It is a sovereign state, effectively owning the future of the world.
While retail investors fight over quarterly earnings and obsess over stock splits.
The architects of this empire are playing a shadow game beneath the surface.
They are quietly, meticulously deploying capital into specific, smaller entities.
This is not charity. It is a master plan, a roadmap.
Today, we decode that map.
By the end of this broadcast, you will see exactly where the smartest money on Earth is flowing and why you might be looking in the wrong direction.
Before we dissect the specific assets, we must first decode the investment philosophy driving these decisions.
This is critical because the average retail investor often completely misunderstands the objective of corporate venture capital. When a titan like Nvidia allocates capital, they are not merely hunting for a quick return on investment or a 10% pop in the stock price.
They are hunting for leverage.
They target companies that serve as the load-bearing walls for the future artificial intelligence infrastructure they are building.
Every dollar deployed is a strategic coordinate. Each partnership is designed to reinforce a competitive moat that is already miles wide.
When you see capital flowing from the GPU giant into a smaller firm, realize that this is not a transaction. It is a signal.
It is a glimpse into the research and development roadmap for the next decade.
The scale of these disclosed investments is approximately $400 million. To the average observer, 400 million is a staggering fortune. To a company, so why do it? Why bother with these relatively small stakes?
The answer lies in influence. By taking equity positions, the investor secures a seat at the table,
Ensuring that these emerging companies build their software stacks and hardware protocols on top of specific architecture. They are cultivating an ecosystem where their technology becomes the oxygen that the industry breathes.
Let us turn our attention to the first coordinate on this map, a company that operates in a sector many have dismissed.
SoundHound is not merely building a basic speech-to-text tool.
They are constructing a conversational intelligence capable of parsing complex context.
Heavy accents and multi-layered languages simultaneously.
Is the difference between a rigid command line interface and a fluid conversation.
They are already embedded with automotive giants like Mercedes-Benz, Honda, and Kia.
But consider the implication of this technology. If every vehicle, smart home,
Point and industrial machine requires a voice interface that processes natural language in real time.
The computational load will be astronomical. This requires parallel processing power on a massive scale. By funding SoundHound, the GPU giant is effectively creating future demand for its own silicon chips. There is a financial metric here that catches the eye of the astute analyst. SoundHound boasts a gross profit margin of 60%. In the world of hardware and software, a 60% margin during a growth phase is a rare signal of pricing power.
It suggests that the market has few viable alternatives and is willing to pay a premium for the technology.
While the company is currently operating at a net loss, a standard characteristic of high-growth tech firms pouring revenue back into research.
Narrative here is clear. Voice is the new interface layer.
By investing now, the infrastructure builders are ensuring that when the world starts talking to its machines, those machines are listening through their hardware.
The second company in this portfolio exposes a vision for the physical world that is both fascinating and, to some, slightly dystopian. Entity is Serve Robotics, and the investment stands at $30 million. You may have seen their units, small autonomous rovers navigating the sidewalks. It is easy to look at these devices and see a novelty, a cute toy.
This data is the most valuable commodity in the world.
The autonomous robotics sector is projected to swell to $450 billion in the coming years, potentially eclipsing.
The core requirements are identical: computer vision, sensor fusion, and real-time decision-making.
But look at the financials, and you will see a horror show.
Serve Robotics has reported a negative operating margin of 1,790%.
Read that again. For every single dollar they make, they burn nearly 8. To a rookie investor, this looks like bankruptcy waiting to happen. But to a Wall Street shark, this is war. This is the classic land grab. They are incinerating cash today to build a monopoly tomorrow.
They aren't trying to be profitable in the short term. They are aggressively purchasing the streets of the future.
We saw this with Amazon in the late 90s. We say it with Tesla during the Model 3 ramp-up.
The companies that dominate the next era are rarely the ones optimizing for short-term profit today.
They are the ones aggressively purchasing the future.
The third investment takes us into a sector where biological complexity meets silicon efficiency.
The company is Recursion Pharmaceuticals, backed by a $50 million injection.
This sits at the intersection of biotechnology and artificial intelligence, a convergence that many analysts.
Recursion is not operating a standard lab. They are running one of the most powerful biotech supercomputers on the planet.
Consider the traditional context of drug discovery. It is a slow, excruciatingly expensive process. Often, Recursion is utilizing AI to compress this timeline violently.
They are simulating interactions between millions of chemical compounds and thousands of disease models in silico, meaning inside.
This changes drug discovery from a biological guessing game into a computational search problem.
The consequence of this shift is profound.
Recursion has already secured partnerships with titans of the pharmaceutical industry, like Roche and Bayer.
These legacy companies are not partnering out of charity. They are partnering out of necessity.
They recognize that the old methods are becoming obsolete. The healthcare AI market is projected to reach nearly $200 billion shortly.
Every simulation run by Recursion, every petabyte of biological data analyzed, burns through GPU cycles.
Now we move to the fourth entity, a company that represents the plumbing of the AI age. It is called Applied Digital builds specialized data centers. This may sound mundane compared to robots and drug discovery.
Applied Digital is constructing the physical shell for the AI ghost.
They are growing revenue at a rate of 124%, a staggering pace for an infrastructure firm. Like our previous examples, they are not yet profitable. Building data centers is capital intensive. It requires massive upfront expenditure on real estate, power grids, and cooling towers. But once operational, these facilities become cash flow machines. The strategic genius here is twofold. First, it secures a built-in demand pipeline for high-end chips. Second, it provides the chip manufacturer with real-world performance data. It allows them to see how their hardware holds up under maximum. Furthermore, Applied Digital has exposure to cryptocurrency mining, allowing for a pivot between AI workloads and inflation.
Finally, we arrive at the crown jewel. This is the investment that explains the future of mobile computing.
Company is ARM Holdings, with an investment totaling $280 million. The backstory here is essential. A few years ago, Nvidia attempted to buy ARM outright for $40 billion.
Regulators worldwide crushed the deal, fearing it would grant a single company a monopoly over the global semiconductor industry.
The acquisition failed, but the strategy did not. Instead of ownership, they opted for a massive strategic investment. Why is ARM so critical? Because their architecture powers 99% of the world's smartphones.
Every iPhone,
every Android, every tablet runs on ARM blueprints. But the moat is wider than that. ARM boasts a gross profit margin of 96%. In the hardware world, 96% is effectively a monopoly. They do not manufacture chips. They sell the intellectual property, the blueprints. They collect a royalty on every chip.
The significance of ARM lies in efficiency. As AI moves from the massive data center to the edge,
You cannot put a data center chip in a phone. The battery would die in seconds.
ARM specializes in high performance with low power draw.
By investing here, the goal is to influence the architecture of the future, ensuring that as AI goes mobile,
ARM is trading at a high valuation, roughly 40 times forward earnings. But for a company with 96% market,
when we zoom out and view these 5 investments as a constellation, the master plan becomes visible.
this is not a random assortment of stocks. It is a vertical integration of the future. The strategy is to surround.
However, we must introduce a note of extreme caution. The narrative of inevitable success is a dangerous illusion. We are in the speculative phase of the AI revolution. History teaches us that in every technological boom,
SoundHound faces titans like Google and Apple. Serve Robotics is one lawsuit away from a regulatory crackdown. Recursion has yet to validate its model with a blockbuster drug. Applied Digital is leveraged in a high interest rate environment.
the risk is real. These companies could fail. But the counter-argument is the risk of omission. The risk of sitting on the sidelines while the global economy is rewired is
The investor must decide if they want the stability of the established titan or the asymmetric upside of the disruptors.
The established titan offers a straight-A financial report, cash flow, growth, and margins. Disruptors offer the potential for exponential returns, coupled with the potential for total loss.
This leads to the question of portfolio construction. Diversification, as often cited by Warren Buffett, is protection against ignorance.
If one knows what they are doing, Concentration builds wealth.
But for the observer looking to participate without exposing themselves to ruin, a satellite approach is often prudent.
This involves holding the core infrastructure provider as the main anchor, the stable, cash flow positive giant, while
Furthermore, we must address the psychology of timing. The amateur investor asks, is it too late?
the data suggests we are merely in the opening innings. The global AI market is projected to surge from 100 billion. That is an 8-fold expansion. The smartphone market, which changed the world, is worth $500 billion.
The question is not if the wave is coming, but who will be left standing when it breaks.
The markets will be volatile. There will be corrections where these stocks draw down by 30, 40, or 50%. This is the price of admission for high-growth assets. The investors who compound wealth over decades are those who can detach.
We have laid out the roadmap. We have identified the coordinates. The machinery of the future is being assembled before our eyes. The map is drawn. The infrastructure is being built. Now, you must decide if you secure your capital, become the investor, claim your victory. This is Capivestor.